The little tool I wanted to share with you, this is still in testing. This is a retirement calculator that I coded up, I guess, last week. And one of the things that bothers me about retirement planning calculators, and you'll see a lot of these, is that they don't really do a good job, at least in my opinion, of inflation adjustments. So I'll give you a quick example here. The way this one works is we put in today's numbers, today's dollars. How much do you think you'll get in fixed income, like Social Security or pension? Maybe you're a teacher or firefighter or something, and you're able to get a pension, unlike the rest of us schlubs out here. And what are your monthly expenses in today's dollars? And what it does then is that it inflation adjusts everything, and you can put in your expectations of your portfolio growth, and then it'll give you like a number of like how much do I need to put in every year, also inflation adjusted, to reach my goals. So let's say I go to SSA.gov, I have an account, and I figure out if I retire now based on their assumptions, I'm going to get $2,200 a month, let's say, which is middle of the road ish. Let's say my mortgage is $2,500 a month. Let's say my healthcare is, I don't know. And if you have a family, you got to think, okay, by this point, the kids will be gone. So let's say that's 1,200. Living expenses, say another 2,000. Travel, because people like to travel when they retire. Say 1,000 a month. And you can add stuff if you want. So that creates a monthly shortfall of 4,500 between the 2,200 here and these numbers there. And so based on that, what is my withdrawal rate? So this is a concept you'll be familiar with if you're in personal finance circles, the safe withdrawal rate. The landmark study for that was the Trinity study. And basically they determined if you have a mix of stocks and bonds and you withdraw 4% a year, also inflation adjusted over time, then chances are very good you'll have money at the end of 30 years. So 4% is kind of the standard number, but you can adjust it. You can go up and down depending on what your particular portfolio is like. And then we go into years to retirement. We can say, okay, I've got 20 years to retirement. Sure. I happen to be 45, so that works. And then you can put in, what do you expect for inflation? 3%, 4%, 2%, whatever. Up to you. And what's your investment return going to be? Average-ish, again, 7% is kind of standard, but you can adjust it. Obviously, the higher your investment return, the better. We want to be realistic. So let's say I have 7.5%, okay? So if I had no savings, no portfolio at all, in order to reach a portfolio that inflation adjusted, it needs to be 2.4 billion in 20 years, I would need to invest $56,000 a year to reach these numbers, to be able to withdraw 4% to pay for all this. That's the idea of the calculator. And then you can see how the cash flows change over time. Now, if I already have some money, let's say I have 250 grand in a portfolio, now my investment required drops down to 31,000. So it's not nothing, but it's definitely less. So the goal here is to give you an idea of the scope of the issue, because what I see over and over again, and have seen for the last 15 years, is that people fail on the retirement savings in two areas. So number one, you got to put enough in. And that could be 401ks, it could be IRAs, it could be taxable accounts, it could be whatever. Real estate, I'm agnostic. Different plans have different tax consequences, but they all do the job in some form or fashion. The other element is you got to leave it alone. You got to leave the money alone to do the work and not take it early and disrupt the growth. If you can do those two things, retirement works. If you can't do either one of those things, if you can do one but not the other, it still doesn't work. The key is to get that idea of what's going on. And maybe it means these numbers need to be lower, and you need to have a lower standard of living compared to, the resources that you have available to you and going on into the future. Just being aware of the issues. That's really what it comes down to. I will put a link to this. This is still in the testing phase. If you have any feedback, definitely let me know. But I'll send out a link to everybody on our email list with this so that you can play around with it and let me know what you think. All right, so that's my updates for this week, and let's move into questions.